They tell you it is a meritocracy. Work hard, save money, climb the ladder. The American dream is available to anyone willing to earn it. That story is repeated so often it feels like common sense. But if it were true, the outcomes would look very different. If effort and discipline were the deciding factors, wealth would not be concentrating faster than at any point in modern history. Yet it is. In 1980, the top 1% owned roughly 7% of total wealth. Today, they control about 32%. That did not happen because millions of ordinary people suddenly became lazy, and it did not happen because the rich collectively became 4 times smarter or more productive. It happened because the system itself was redesigned, not accidentally, not as an unintended side effect. It was deliberately reshaped to move wealth upward. Once you understand the mechanics, it becomes clear that this is not a broken market or temporary imbalance. It is a machine. A wealth extraction machine that has been operating for decades. And for it to work, someone has to be drained. That someone is everyone who lives off wages. The poor do not fall behind because of individual failure. They fall behind because every rule, every policy, and every crisis is structured to pull value from the bottom and push it to the top. This is not about motivation or personal responsibility. It is about design. And the most fundamental mechanism of that design starts with the split between assets and wages. Since 1971, when the dollar was severed from gold, governments gained the ability to create money without a hard limit. Trillions of dollars have been created since then, especially during crises. But here's the critical point most people miss. That money did not flow evenly through society. It entered through the financial system. Banks, markets, and large institutions got it first. And when new money enters at the top, it does not raise wages. It inflates asset prices. Stocks, bonds, real estate, private equity, everything the wealthy already owned began to surge. If you held assets in 1980, you did not just keep up, you won. Your house multiplied in value. Your stock portfolio exploded. Investment properties turned into cash machines. But if all you had was your labor, if the only thing you could sell was your time, you lost. Wages barely moved. From 1980 to around 2020, worker productivity rose roughly 70%. Corporate profits increased more than 400%. Real wages, adjusted for inflation, rose about 10%. Think about what that means. You are producing dramatically more value than previous generations, but you're taking home almost the same purchasing power. The extra value did not disappear. It was captured. That missing 60% flowed upward to shareholders, executives, and asset owners. The shift is visible everywhere. In 1980, the average CEO earned about 40 times the average worker's pay. Today, that number is over 350 times. CEOs did not suddenly become 9 times more competent. What changed was how they were paid. Compensation shifted away from salary and toward stock options and equity-based rewards. Stocks soared due to money creation, buybacks, and financial engineering. Executives were paid in assets. Workers were paid in wages. And in an inflationary system, wages always lose to assets. This was not a coincidence. It was a restructuring of incentives so that the people at the top benefited directly from policies that inflated markets, while the people at the bottom absorbed rising costs. Then comes credit, where the system turned from unfair to vicious. Rich people borrow cheaply. Poor people borrow expensively. That single gap compounds into generational wealth on one side and permanent insecurity on the other. If you're wealthy and own assets, banks treat you as low risk. You can borrow at 2% or 3%. You can take out mortgages to buy rental properties, business loans to expand companies, or margin loans against stock portfolios. And because asset prices rise faster than the interest you pay, borrowing itself becomes profitable. Inflation does the work. Appreciation pays down the debt. This is how the rich use leverage to multiply wealth. They borrow cheap money against assets that are already rising and let time erase the loan. But if you are poor, credit is not a tool. It is a trap. You borrow because you have to. A car loan to get to work. A credit card to fix a furnace in winter. Student loans just to access basic employment opportunities. And every time you borrow, you pay a penalty for not already being wealthy. 12%, 23%, sometimes more. That interest is not accidental. It is extracted value. It flows directly to banks and then upward to shareholders and executives. A wealthy borrower might take out $1 million at 3% to buy an investment property. Their interest costs $30,000 a year. The property appreciates at 5% or $50,000. They make money simply by borrowing. A poor borrower might carry $20,000 on credit cards at 23%. Their interest alone is $4,600 a year, spent on necessities that do not appreciate. One borrower is paid to borrow. The other is bled for survival. Then there are taxes, where wealth extraction becomes fully legal. The tax code overwhelmingly targets labor, not wealth. If you work for a paycheck, you pay income taxes at every level. By the time it is done, around 30% is gone. But if your income comes from investments, you face capital gains taxes, which are lower. And the truly wealthy often pay even less than that. They use a strategy commonly called by borrow, die. Instead of selling assets and triggering taxes, they borrow against them. If you own $100 million in stocks, a bank will happily lend you $20 million at low interest. You live on the loan. Loans are not income, so they are not taxed. You pay no income tax, no capital gains tax. When you die, your heirs inherit the assets at a stepped-up basis, wiping out the original tax obligation entirely. This is not a loophole accidentally left open. It is a feature. It is how wealth becomes permanent. It is how fortunes survive generations untouched by the tax system that funds a state everyone else depends on. And when crises hit, the pattern repeats. Markets collapse, panic spreads, and governments step in. But who gets rescued first? Asset holders, banks, corporations. Liquidity is injected to stabilize markets, which pushes asset prices back up. Workers might get temporary relief, but wages do not surge. Rent does not fall. The system resets at a higher level of inequality. All of this is justified with the language of efficiency, growth, and stability. You are told this is just how capitalism works. But capitalism, as sold in theory, is about competition and risk. This version privatizes gains and socializes losses. It rewards ownership over contribution and leverage over labor. Once you see the structure, the outcomes stop being mysterious. The rich keep getting richer because the system was built to make that inevitable. The rest fall behind not because they failed, but because they were never meant to win. The machine does not ask for your belief. It only needs your participation. They can sell the stocks and legally pay little to no tax, then use the proceeds to settle the loans they lived on for years. The entire fortune moves from one generation to the next without being meaningfully taxed. This is how billionaires end up paying lower effective tax rates than their secretaries. It sounds absurd, but it is documented, routine, and completely legal. And it is only possible if you already sit at the top. Meanwhile, you are taxed on every dollar you earn before you even see it. You can't borrow against your future wages at 2% interest. You can't pass your income to your children tax-free. You are taxed at the highest rates on the weakest, most fragile form of wealth, labor. That is not a coincidence. Labor can't hide offshore. Labor can't be parked in a trust in the Cayman Islands. Labor can't hire teams of accountants to turn income into something else on paper. You show up, you work, you get taxed. The money flows upward. That is the baseline design. And to really understand how intentional this is, you have to look backward. History has run this experiment before. Go back to the Gilded Age, roughly 1870 to 1900. A small group of industrialists, Rockefeller, Carnegie, Morgan, Vanderbilt accumulated wealth so vast they did not just participate in markets. They controlled them: oil, steel, banking, railroads. They owned the infrastructure of the country. Everyone else depended on them for survival. Wages were low. Hours were brutal. Child labor was not an exception. It was normal. There were no safety standards, no minimum wage, no overtime, no weekends. If workers were injured or killed, they were replaced. And when workers tried to organize, tried to push back, the response was not negotiation. It was violence. The wealthy hired private armies. Pinkertons and strikebreakers were sent in. Workers were beaten, jailed, and in some cases shot in the streets. This was not the free market people like to romanticize. It was feudalism with smokestacks. Wealth and power concentrated to levels not seen since European aristocracy. And it did not correct itself. It did not naturally balance out. It took decades of strikes, bloodshed, and eventually government intervention to break the grip. Antitrust laws, labor protections, progressive taxation, the New Deal, unions. All of it was designed with one goal: prevent wealth from concentrating so much that democracy itself collapsed. For a while it worked. From the end of World War II until about 1980, inequality fell. The middle class expanded. Wages rose alongside productivity. A single income could support a family. That period was not perfect, but economically, it was the most balanced era in American history. Then the direction flipped. Starting around 1980, policy after policy shifted in favor of capital over labor. Top tax rates were slashed. Unions were weakened and broken. Financial markets were deregulated. Jobs were shipped overseas in the name of efficiency. Money was allowed to move freely across borders, while workers were told to compete globally. Predictably, the wealth gap exploded. Today, we are back at Gilded Age levels of inequality. The richest Americans now own a larger share of the country than they did in 1929, right before the Great Depression. And just like before, they're using that wealth to buy political influence, suppress labor organizing, and rewrite the rules to protect themselves. The names have changed. The tactics look cleaner, but the structure is the same. Most people do not see it because the mechanisms are more sophisticated. Rockefeller used monopolies and hired guns. Modern billionaires use lobbying, regulatory capture, and tax havens. Different tools, same outcome. Wealth flows upward. Power concentrates. Everyone else falls behind. Now look at crises, because this is where the machine really accelerates. Every major economic crisis in modern history has followed the same pattern. The rich emerge richer. The poor emerge weaker. Take 2008. Banks gamble with mortgages, package junk into complex securities, and nearly collapse the global economy. Millions of ordinary people lost their homes, their jobs, and their savings. Entire neighborhoods were hollowed out by foreclosures. Retirement accounts were cut in half. It was the worst financial disaster since the Great Depression. And what happened to the people who caused it? They were rescued. Governments printed trillions of dollars and handed it to the financial system. Public money stabilized private balance sheets. Wall Street survived. Main Street did not. Investment firms and asset managers then used that newly printed money to buy foreclosed homes at pennies on the dollar. BlackRock, private equity firms, hedge funds scooped up hundreds of thousands of houses. Families who had just lost their homes ended up renting them back. The 2008 crisis became the largest upward transfer of wealth in American history, financed by taxpayers. Then came 2020. The pandemic shut down the economy. Governments responded by printing roughly $6 trillion to prevent total collapse. Some of it reached ordinary people through stimulus checks, temporary relief that barely covered rent for a month or two. But the vast majority flowed into corporations and financial markets. The stock market crashed in March 2020. By June, it had recovered. By the end of the year, it hit new all-time highs. Not because the economy was thriving, but because the Federal Reserve flooded markets with liquidity, bought bonds, and held interest rates near zero. Asset prices were protected at all costs. If you owned stocks, you got richer. The wealthiest Americans added over $1 trillion to their net worth during the pandemic. For billionaires, it was one of the most profitable periods in history. Meanwhile, millions of workers lost jobs. Small businesses closed permanently. Renters fell behind and faced eviction. Inflation surged soon after, eroding whatever savings people had left. Once again, crisis became a tool for wealth transfer. Assets were inflated. Purchasing power was destroyed. Notice the pattern. Something breaks. Authorities intervene. Money is created. That money flows upward first. Asset prices recover quickly, often overshooting. Wages lag or stagnate. Jobs do not fully return. And people at the bottom are left with more debt, higher costs, and less security than before. This is not a failure of the system. It is a system functioning as designed. Crises are not bugs. They are features. They clear out the weak and consolidate ownership in fewer hands. And underlying all of this is simple math, compounding. If you start with $1 million and earn 8% annually, you double your money in under a decade. Over 20 or 30 years, it snowballs into tens of millions. You do not need to work harder. You just need to already own something. If you start with nothing, you do not compound. You earn linearly. You trade hours for dollars. When you stop working, income stops. Inflation quietly erodes what little you manage to save. Over time, the gap between compounding wealth and linear wages becomes unbridgeable. This is the engine of inequality. And once it is running, it does not slow down on its own. So the distance between you and the person who started with $1 million keeps expanding year after year. Not because they are more talented or disciplined, but because math is doing the work for them. Compound returns on assets will always beat linear income from labor. There are no exceptions. That is why inheritances matter more than resumes. That is why starting points determine outcomes long before effort ever enters the picture. If your parents pass down nothing, you are beginning at zero. And even if you do everything right, save aggressively, avoid mistakes, invest carefully, you are still racing against someone who began miles ahead. The numbers do not bend. You can run faster, but the gap still grows. Now add inflation to the equation. When governments create money, asset prices rise. Houses, stocks, land, gold, everything that can store value inflates. If you already own those things, your net worth climbs effortlessly. If you do not, if you're trying to buy your first home or build retirement savings, everything just moves further out of reach. Prices rise faster than wages, and once again, the gap widens. That is why the housing market feels broken. In 1980, the median home cost about 3 times the median household income. Today, it is more than 5 times. And while mortgage rates were higher back then, houses were cheap enough to pay off quickly. Equity built fast. Today, even with lower rates, prices are so extreme that monthly payments consume a larger share of income for decades. You are locked into 30-year debt, building equity slowly, while existing owners watch their net worth balloon. The people who bought early did not become smarter. They did not suddenly add more value. The system inflated what they already had. That is the brutal truth. If you start with capital, the rules favor you. If you start with only labor, the rules work against you. Capital gets cheap credit, low taxes, and compounding returns. Labor gets expensive credit, high taxes, and linear income. Capital benefits from inflation. Labor is crushed by it. Capital is mobile. It can cross borders, shift jurisdictions, and chase the lowest tax burden. Labor is fixed. You can't move your job, your family, your life every time the rules change. And the people who own capital also write the rules. They fund political campaigns. They influence regulators. They shape media narratives. So you are told inequality is about merit, personal choices, or motivation. But it is not. It is about ownership. It is about a system that rewards what you own and penalizes how you work. So what should you take from this? First, understand that you cannot outwork a rigged system. Working harder alone will not make you wealthy if the value you create is structurally siphoned upward. Income matters, but ownership matters more. Second, recognize that debt is a weapon. High interest debt keeps you trapped. Cheap debt builds empires. The problem is not debt itself, it is access. And access is deliberately restricted to those who already have money. Third, the tax code is not neutral. It favors wealth over work by design. Learn the rules or find someone who understands them, because the wealthy are using every advantage available. Ignorance is not punished equally. It is punished at the bottom. Fourth, crises are wealth transfer events. They always have been. The next one will come just like the last ones did. When it does, assets will be cheap for those with liquidity and access to credit. If you have neither, you won't be buying. You'll be selling to survive. Fifth, generational wealth matters. If you can't inherit it, you have to build it. That means sacrificing consumption now to accumulate assets that compound later. It is not fair, but it is reality. History shows this pattern again and again. Wealth concentrates. Elites emerge. The majority falls behind. It happened in ancient Rome. It happened in feudal Europe. It happened during the Gilded Age. And it is happening now. The only times the cycle reversed were when people organized, resisted, and forced structural change. None of those gains were handed out voluntarily. Labor rights, progressive taxation, and a strong middle class were won through struggle. And now, those gains are being dismantled. Unions are weaker. Taxes on the wealthy are lower. Wages are stagnant. Wealth is concentrating faster than ever. We are drifting toward a modern form of feudalism, where a small elite owns everything and everyone else rents, borrows, and works until the end. Not because it is inevitable, but because it is profitable. Here's a harsh reality. Most people won't push back. The system is extremely effective at keeping people exhausted and divided. You are working multiple jobs. You are buried in debt. You are focused on survival. And that leaves no time, energy, or security to challenge the structure itself. A population struggling to stay afloat does not organize. It does not resist. It adapts. And that is exactly what the system counts on. History may not repeat word for word, but its patterns are unmistakable. The rich get richer because the system concentrates wealth. The poor get poorer because every mechanism credit. Taxes, inflation, crises extract from the bottom and delivers to the top. This is not an accident. It is the feature. And until you see that clearly, you will keep playing a game that was never designed for you to win. If this changes how you see the world, stay curious. History already ran these experiments. The answers are there if you know where to look.